When it comes to retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated like a number. This is your retirement. So it's time to think differently. And you're in luck because you found the Retire Your Way podcast with Dave Lopez, founder and managing member of ILG Financial. At ILG Financial, you won't find generic run-of-the-mill plans containing the same old cookie-cutter solutions. Dave and the ILG Financial team focus on building one retirement plan at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hat and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now. Coming to you from the ILG Financial Studios, this is Retire Your Way, the podcast that gives you the straight talk and honest insight you need to help you achieve your financial goals through smart investing and careful planning. My name is Jeff Shade, and as always, I'm just here to ask the questions, but the words of wisdom and solid advice come from Dave Lopez, managing member and owner of ILG Financial. How you doing today, Dave?
I am doing great. It's sure good to be back on the air together.
Yeah, it's great to be with you, Dave. You're sort of a reassuring voice in all the turmoil and all the things coming into our ears these days that are not so positive. It's great to talk to you, a very, very positive guy. And I guess these days about the best we can do is just put one foot in front of the other, right? And solve one problem at a time.
Well, there are times in life that's the way it is. And I remember growing up talking to the kids about things, and you watch too many Disney shows or the public education, which teaches you that everybody's a winner, and we get this feeling that things always go up, right? Up 3% or up 5% on a steady incline. And of course, any of us that have been around a while, and that includes me, Jeff, you realize that's not how the world works, right? It goes up and down more like a wave and a sine curve. And there's times when you do very well, and then there's times where you're just kind of holding on by your fingernails, and the goal is just to stay in the game until the tide turns. And there's a reason that you've got old sayings, which usually are based in fact, aren't they? But old sayings like, it's always darkest before the dawn. And I think that's what that saying talks about, is we're in a period right now of great unrest. You're hearing terms like unprecedented, and you're hearing indecision from the regulatory bodies. People don't know kind of what's going to happen next. And sometimes the best thing that we can do is just hold on, try to limit any negative impacts, and just stand our ground until things take a turn. And I think we're in a period like that. But the good news is there are things you can do. And we talk over and over with our clients, Jeff, about this idea of being a proactive investor versus being a reactive. And what I mean by that is it's human nature. And we have found this over 11 years that folks usually fall, for the most part, in one of two categories for how they process information. One is what we call a reactive personality, which is they don't like to address bad news. They don't like to confront negative information. So they kind of trick themselves, pretend it's not happening, or think it's out of their control, so I can't do anything anyway. I guess what happens. And then when the negative events happen to them and they lose money or they lose their job, and they think, well, there's nothing I could have done. It's just the world. The world's out to get me, or the world's going to heck in a handbasket. The reality is there's another type of person that is a proactive processor of information. What I mean by that is when they see potential for negative information or negative outcomes in their life, they will dive in. They will look at the uncomfortable information and see if there's anything they can do to either mitigate the damage, avoid the damage altogether, or possibly prosper in light of what's happening. And those people come out at the other end in a much better position. So one of the things we talk about with our clients is, that old medical axiom, know thyself? Have you ever heard that before?
Yes.
Well, this is one of those times where we tell people, listen, don't run away from the reality of who you are. Understand who you are, because there's going to be winners and losers in the financial world based on how things go. You saw it in the Great Depression. Everyone talks about the Great Depression, Jeff, as a time where people lost their life savings and they lost their homes and it was horrible unrest, and all of that is true. But what you don't hear people talking about is there are folks that profited because they positioned themselves in a position where not just them, but 2 and 3 generations of their family to follow them reap the benefits of actions they took to avoid the negative impacts. In 1929, the market roughly dropped about 70% from top to bottom. And it took over 20 years to get even if you had been in a buy and hold mode. 20 years plus. But imagine if you had seen what was coming and you had just taken some actions to try to avoid the 70% loss and then move back in the market later. That would have been the best 20 or 25 years investing-wise of your life because you didn't have to make up losses. So that is a long-winded way to start the show to say it's a very positive. Yes, things are uncertain, but there's things we can do if you're willing to address the uncomfortable, take a look at what's going on, and very pragmatically say, hey, if this is the way things are going to go, is there something I can do to mitigate the downside?
Words of wisdom there from Professor Dave, and you're right. I think to get ahead sometimes you do have to get into that uncomfortable zone and do what is necessary. Another good point that you made there, Dave, is that there's always a silver lining out there. As you said, during the Great Depression, a lot of people found ways to make money, and during this period of time, there are people who have done the same thing by manufacturing masks with logos on them or making those shields between you and the other person. So there's always a silver lining out there. And the other thing, too, I think that's really important for what you just said, Dave, is perseverance. It's just to keep putting one foot in front of the other, just keep moving forward. Sometimes you might go really quickly like the hare, and other times it's like the turtle. But we know the old tale there is that the turtle, the slow and steady, does win the race. So, Dave, words of wisdom from Professor Dave, who's been around the block a couple of times, I think, there, too. Well, on today's podcast, Dave, I want to talk about the market here, the stock market in particular, and why it is going up. Despite a global pandemic and double-digit unemployment in the United States, the S&P 500 stock index reached a new high just recently. So, as irrational as it might seem, there seems to be a bit of a disconnect here between COVID-19 and problems going back to school and this contentious election. On one hand, things seem to be just a little negative, but on the other hand, the stock market is not reacting to that. Why is that, Dave?
Yeah, and that's a great question, and it really fits right in with what we've just been talking about, is that instead of just, thinking that you're going to ride whatever happens one way or the other and really be a victim of circumstance, this is a perfect example of a time where what you ideally want to be doing is just taking a step out of emotion and just trying to very pragmatically look at what's going on, analyze it, and see to yourself, what does that mean moving forward? And how can I either protect myself from losses or even take advantage of what may be coming? Best guess, we're always guessing a little bit based on what's going on. So let's dive right into this because it's very interesting. As you said, Jeff, there's no rational reason when we're in economically the worst situation we've been in, going all the way back to 1929. And article after article will talk about how they really can't compare what we're going through now to any other time period other than 1929. You're at 30 million, 25 to 30 million unemployed right now. Many of these jobs are not coming back. We just saw a great article talking about the restaurant industry that says they conservatively feel like 60% of the restaurants will not come back from this. That's huge. So you've got schools shut down, you've got sports shut down, and every business that support those are affected. How in the world can the market kind of be going through the roof in the face of all of this? Well, there's 5 things I want to touch on today that are causing that. And from that, we can make some extrapolations as to what to do moving forward. And I would encourage you, after you hear this, if you've got some questions, pick up the phone and call us. And let's talk about your specific positions, your portfolios, your goals in retirement, and what we can do for you all, because there are going to be winners and losers from this.
That's right, Dave. And the first one is the stock market is forward-looking. Explain that a bit, if you would, please.
Yeah, what that means is that when people are deciding to buy into the market or sell from the market, it's not based on where the market is necessarily today or what's going on in the news today. Basically, these decisions are being made to buy or to sell based on where we perceive the economy and indirectly then the markets to be 12 to 18 months or more from now. So one of the reasons the market's looking up is it's telling you that people buying in, the folks that are buying and driving the price up, have the perception that 12 to 18 months, things are going to be dramatically better than they are, and then they're going to have a continued period of things getting better and better and better. So they have a very rosy outlook of the near term after 12 to 18 months, and they think the markets from there is going to go through the roof.
So they're really betting on the future, and their bet is that the future is going to be a lot brighter than it is today and thus affect the stock market.
Yeah, that's right. And if you recall from some of our webinars and some of the other podcasts we've done, we talked about even back in April and May, what the economists were talking about a recovery. And the first thing that they said is we were going to have what was called a V as in Victor, a V-shaped recovery, which means the market went down and the economy shut down, and then it immediately popped straight back up. And within 12 months, we were rolling at all cylinders again. And even if you can go back and listen to our conversations back in April and May, I said, it's just the numbers, this does not make sense. It seemed more like propaganda trying to make everybody feel good. You could have more of a U-shaped recovery, which means that, the market and the economy go down, and then, it takes a little time, maybe a year or two, to turn the corner before it starts to shoot back up. And then I even predicted back in April and May that it was probably going to be more like what's called an L-shaped recovery, meaning the market's down and then you're hoping it turns back up, but it stays down for a little period of time, maybe 36 months, 24, 36 months, before it slowly starts to recover, kind of like what you saw in Japan when the market tanked in '89. They've still not recovered their stock market from that crash. So one of the things we talk about moving forward is folks are betting on this V as in Victor shaped recovery. I talk about this all the time, is I think everyone's so focused on which is another one we'll talk about, this vaccine, that they're not looking at other factors. And we'll talk about that kind of in the next segment. So let's move on to number 2.
And number 2, Dave, is the big just keep getting bigger. I've heard about these FANG stocks, F-A-A-N-G. Explain that.
Yeah, so this is an interesting one. When folks say the market is going through the roof, you hear it on the news, right? What they're really talking about is the S&P 500 or maybe the Dow. That's not the stock market. That's one index that holds some stocks. But it's very easy, because that's the soundbite we hear, to assume that's what the entire stock market's doing, and it's not. Perfect example is the S&P is a weighted stock market. So what that means is let's say there's 500 stocks in the S&P 500. Each stock is not 1/500th of the return in the S&P 500. It's weighted based on the size of the company. So let me give you an idea of how big of a deal this is. The FANG stocks that you had alluded to is Facebook, Apple, Netflix, and Google. If you go back to 2015, they represented about 3.5% of the S&P 500. Today, they represent over 16% of the S&P 500. And if you add Apple and Microsoft to that batch, because they're very similar, it accounts for over 21% of the S&P 500. Those companies have been going through the roof because of the situation we're in predisposes these huge companies to really prosper in this situation, because their competition's being wiped out, and because a lot of what they do you can do from home. Think Facebook, think Amazon, think Netflix, and Google. So they're really doing well, but that's, 5 to 6 companies are doing well. The rest of the S&P 500 is not faring nearly as well. In fact, some companies are faring poorly. The last time I checked, the bank stocks in the S&P 500 are still down over 30% from the March correction. So things aren't what they seem, but if you're just tracking the S&P and most of the up is from these several companies, if you're not in these several companies, you have a very different reality.
We're talking about why the market is going up despite COVID-19. Back to school, the election with Dave Lopez of ILG Financial. Our show, of course, is called Retire Your Way. And we want to continue with this, Dave, but I do want to remind our listeners that if you would like to have a no-cost, no-obligation financial plan with Dave, maybe get started on a good plan for retirement. Maybe you've already got a plan and you're really looking for a second or a third opinion on that. Of course, Dave is offering that today for our loyal listeners. You can get it by calling 540-720-5656. That's 540-720-5656. You can also request it online at ilgfinancial.com. Dave, let's continue to talk about why the market is going up. We talked about the market being forward-looking, and the big just keep getting bigger, those FANG stocks there. But I think another thing 12 to 18 months into the future is that people are really just betting on a vaccine. They're really hoping that in a year to 18 months from now, we're going to have this vaccine.
Yeah, that's a big bet, isn't it? But more importantly, think psychologically of what's going on. What's happening is everybody's attention is so focused on the vaccine and the pandemic that they're really not looking at anything else, which is what's dangerous. So I say all the time that, people are just believe that, hey, in, 30 to 60 days, maybe 90 at the outset, this vaccine's going to come across the table. And then 2 weeks from that date, the entire world will be vaccinated. And then 3 weeks from that date, this will all be in the rearview mirror and it'll be like we had a big snow day. Every business will open back up. Everyone will go back to work, those 25 million people, and all will be good. Well, that's not the reality. And I'm going to give you a couple things to consider. We still don't have a vaccine, Jeff, for AIDS. And we've been working on that for 40 years?
That's right, Dave. It does appear that it's been at least 4 decades now.
Yeah, we still don't have a vaccine for the flu, and we've been trying forever. And this is, everyone admits this is very flu-like. Many of the medical articles that go over our desks say, it may be 10 years. For the next 10 years, we may be dealing with some version of this. Now, I don't believe we're going to be on lockdown for 10 years, but the idea that this is going to magically go away in 30 to 60 days is just not based in fact. So what happens is, and a lot of folks believe this, is even if we do get a vaccine of some sort in 90 days, that's when the lights will come on. And all of a sudden, now that the vaccine's here, people will realize, hey, we're not going back to complete normal. Many of these 25 million jobs are not coming back immediately. It might take 7 or 10 years to get back to where we want to get with those. And some of these companies are gone for good, and travel may be changed forever. And that's when all of a sudden that stuff sinks in, and that's actually when I think the true recession may begin.
We're talking about why the market is going up with Dave Lopez of ILG Financial. Next one, Dave, is that the market seems to be the only game in town that you can play.
It's true. And these last two are the most disconcerting, meaning if you just do nothing, I think they could really come back to haunt you. But if you understand what's going on, you can take some action. So what we mean by the only game in town is with the Federal Reserve's plan to just continue to print money for the foreseeable future. That's not a guess. They've actually come out and said publicly, we are willing to do quantitative easing to infinity, which is Fed speak for we're going to print money as much as it takes for as long as it takes to avoid a meltdown. Well, you can't print money forever. You don't have to be an economist to know you cannot print money forever indiscriminately and not have repercussions. But the point is as they're printing money, they're actually holding down interest rates, artificially keeping them low. And the result of that, and this is intentional, is folks that ordinarily, Jeff, wouldn't invest in the market because they're not willing to take the risk, are forced to participate in the market because the alternatives, the safe money alternatives that they're used to, CDs and government bonds, are paying 1% or less. So you're artificially propping up the stock market by forcing people who don't want risk to go in a time where the market really couldn't be riskier by many people's appraisals. So as soon as interest rates do finally start to click up, or you start to see some negative volatility, what do you think is going to happen with these people who are predisposed to avoid risk when the markets takes a flash crash of 7 or 10%? You could see a huge exodus from the market in a panic, which wouldn't be a good thing.
All right, Dave, let's talk about the fifth one here in our list, and that is help from Washington.
Yeah, so One of the things with the Washington situation is for the first time for many of us, the veil is kind of being lifted on the government, and we're seeing that, hey, it is a dysfunctional organization. Now, we joke about it all the time, but there's this belief that they've got everything handled. And what you're starting to see with this pandemic, both how they deal with the pandemic and how they deal with the economic fallout from it, it feels like, you've got these folks just ad hoc making decisions day to day, and nobody really knows what's going on. But when they're playing with stimulus money and just throwing money out there into the public, it's artificially propping things up. So a great example would be in April, May, when for the first time in history, and this is a big deal, Jeff, the government said we're going to start buying corporate bonds, ETFs that have corporate bonds, and actually corporate bonds. Well, one of the things they're doing is now they're actually picking and backing winners and losers in the private industry market based on whose bonds that they buy. But the other thing is they're artificially propping the bond market up, causing the price for bonds to be higher than they would otherwise be, although they're not limiting the risk. Now, likewise, when people are in the stock market and they see this, they say, listen, we're getting the signals from the Fed that they're not going to let the stock market crash. If necessary, they will be willing to do, by their own admission, quantitative easing to infinity. So their perception is we really don't have a lot of downside risk in the market because the government will swoop in, print trillions of dollars if necessary to prop the market up. Well, there's no guarantee that they're going to do that. And if they do it, there's no guarantee that that would work if people understand that the money could be worthless if you keep printing it.
Yeah, it's sort of like monopoly money at this point in time. It just doesn't seem real, and they do keep printing it. But as you said, the printing press is going to run out of ink or paper at some point in the future, so we really got to do something about this. I have read, Dave, I don't know if this is true, that there were a number of Americans who, of course, became unemployed and got that additional $600, and they actually took that $600 a week and invested it into the stock market. Would that have been a wise thing to do, do you think?
Well, in hindsight, it's easy to say, right? The market's been going up, so short term, it's brilliant. And if we had a crystal ball, this investing business would be very easy to do. So whenever the market's on a tear, and there's a name for what's happening in the market right now, it's not just a market going up, it's called a melt up. And it basically means irrationally bidding the market up at unreasonable increases in the short term. We saw it in '08 with the real estate market, just ridiculously high growth over short periods of time. And that's just everybody piling into the market with this, it's called a greater fool theory, right? They're thinking, I know this can't go on forever, but it's going on right now. And as long as I can get out and sell my stocks to a greater fool before it crashes, I'm fine. So a lot of these people that are doing what you're talking about, a lot of the millennials are playing with the market right now. There's a interesting article says that a lot of folks that bet on sports gambling because sports were shut down have gone into the market because they found this is a way to take care of their betting need and participate. And that's been driving the market up as well. Well, it works until it doesn't, right? Just like any Ponzi scheme, sooner or later, someone's going to say, I'm not going to pay over $2,000 for Tesla stock when they haven't ever made a profit. It's not worth that. And then people will take a step back, whether it's Tesla or anything, and say, well, wait a minute, what are these companies worth? And then the reality is going to hit. So you just have to understand there's nothing new under the sun. The market never goes up forever. When you have price to earnings ratios like we have now that are higher than historical averages and mirror, basically 1999, you're probably going to get similar results. This is not a new normal. They say that every time the market goes on a run, that this time's different, and it's not different. So what you want to do is try to protect yourself from a major correction. Or if you're willing to keep riding this up, be willing to ride out a major negative. And usually when we tell folks, if you're not willing to leave your money in for at least 10 years minimum due to a correction, you probably have no business being in the market for 10 minutes.
Dave, I had to check a little bit there when you were making the analogy of sports bettors who went into the market and they're betting now to satisfy that itch that they've got. Gambling, I mean, the market, is it really gambling when you invest in the stock market?
It is if you're getting in the market on the short term, so day traders and things like that. But this huge group of people now that are anybody who's saying, oh, I'm going up, I've had a great 3 or 4 months, I'm just going to ride it out for now, but I'm watching it close, I'll get out before it crashes. That's literally the definition for gambling, isn't it? So remember, the market is not if you're a long-term investor, you're not looking at the market short-term. You're looking at where we're going to be 10 years down the road with some of the companies you buy. That's the ideal way to do it. So if that's not what you're doing, then just be honest with yourself and acknowledge that you're gambling. And it is a very, very risky time to be gambling in the market at all-time highs. But the trade-off to that, to be fair, is when the risk is very, very high, that's also when you get high rewards, right? So the folks that have taken a chance over the last 4 or 5 months from, April, well, they've won, right? They gambled and they've won. But does that mean that's going to happen over the next 3 to 4 months? Maybe, maybe not. That's the definition of gambling. So just understand if you want to be gambling in the market, or do you want to be building a retirement strategy that's going to survive regardless of how the market performs. How you invest will be different based on how you answer that question.
Well, I'm not a gambler, Dave, never have been, and the investments that I have made have been based on as much information as I could get. And of course, having someone like yourself in my corner too, who can help mitigate some of the risks there too. So we've been talking about why the market is going up on this podcast. Number one, the stock market is forward looking. Number two, the big just keep getting bigger. The Facebooks and the Amazons, the Apples, that sort of thing too. Betting on a vaccine. We're hoping that a vaccine will be here sooner than later. Number four, the only game in town, the stock market, is really the only casino in Las Vegas, so to speak, and of course, help from Washington. If you would like to have a financial plan with Dave, get him in your corner so that you can mitigate the risks and maybe not be a gambler, but more of an investor. Of course, Dave is offering a no-cost, no-obligation financial plan for our loyal listeners to this podcast. Once again, call 540-720-5656 to get yours. No cost and, of course, no obligation whatsoever. Just a chance for you to kick the tires there at ILG Financial and see if it's a good fit for you. That number again, 540-720-5656. You can also request it online at ilgfinancial.com. Well, Dave, we just get started, then we're out of time. I want to thank everybody for listening to us and invite you to join us again next time for another Retire Your Way podcast with Dave Lopez. For Dave, I'm Jeff Shade. Have a great day. We'll talk to you again soon.
The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and not necessarily represent the views of AlphaStar Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through AlphaStar Capital Management, LLC, an SEC-registered investment advisor. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability. AlphaStar and ILG Financial LLC are independent entities.